Okay, good morning, everyone. Dan Bates, President and CEO, Greater Hamilton Chamber of Commerce, and we are thrilled you could join us today for coffee and conversation. So today we're going to be learning about the big, beautiful bill, and it's all about planning ahead. So really pay attention, stay tuned. We're going to be hearing from Kirsch CPA, and I'm going to let them introduce themselves because I'm sure there's credentials they want to mention, and I will probably mess that up. So we'll let them introduce themselves. So you know who I am. We're going to do self-introductions in just a second. But let me tell you how this works. We are on a Zoom call. If you have questions, I'm sure the speakers won't mind if you interrupt them and ask those questions. If you're on Facebook Live, which is the larger part of our audience, type your questions in, and either Tiffany or Laura will get those questions answered for you. So let's get started. Who's doing self-introductions? Is that you, Jason?
I think so. Tiffany hasn't logged on just yet. Hey, everyone, I'm Jason Michael Miller with the Greater Hamilton Chamber of Commerce, Director of Membership and Engagement. Um, Deanna, would you like to introduce yourself?
Hi, I'm Deanna Cosina with ADG Painting Services.
Frankie, would you like to introduce yourself?
Yeah, Frankie Pay, controller at Matandi Steel and Metal Products.
Diane, would you like to introduce yourself?
Hello, Diane Glover with Kirsch CPA Group.
Nancy, would you like to introduce yourself?
Sure, I'm Nancy O'Neill with the Greater Hamilton Chamber.
Sarah, would you like to introduce yourself?
Good morning, Sarah Powers with Kirsch CPA Group.
Tom, would you like to introduce yourself?
Tom Keehan with 3D Color and Vascular Manufacturing.
Hi, Jennifer. I see you just logged on. Would you like to introduce yourself?
Yeah, I'm Jennifer Kendall. I'm the housing coordinator with Serve City.
Awesome. I think I have everybody on here. So, Jared, would you like to take it away?
Absolutely. Yeah, thank you very much to everybody for joining and also to the Hamilton Chamber for having us on. My name is Jared Weyler. I'm a CPA with Kirsch CPA Group. Me and Sue Schlomer, we kind of co-lead our tax practice. So obviously this is kind of right up our alley, the big tax law changes with the one big beautiful bill. So we're really excited to be here and give you guys some more information on some of these changes. So I'll go ahead and share my screen if that works.
Yes.
You should be able to now.
Perfect. Screen two. Can you guys see our logo?
Yep.
Yes.
Awesome. Perfect. So as they mentioned, we're here to talk about the One Big Beautiful Bill Act that was signed in July. There's a lot of different provisions in here that affect various things, but really what we're going to focus on are the tax provisions. And this says business taxes, but as a lot of the business owners and the people serving business owners know that the business and the individual really work hand in hand from a tax standpoint. So we're going to kind of cover the whole holistic approach, and there's a lot of really important changes here that will impact kind of the planning and the tax returns for 2025 and going forward. So just a little bit of a disclaimer. We are still waiting for some guidance on some things from the IRS. So the information we're presenting today is what we know as of September 23rd. There'll be more information as the IRS takes their position on some of these different provisions. But the information we're presenting today is kind of what we know and what we believe to be true right now. So why are we having this conversation on September 23rd? Well, it really comes down to tax planning. Because in order to make changes from a tax standpoint, you need time before the end of the year to act and make those changes. So tax planning really starts right now to align your tax strategy with your business strategy. The ultimate goal of tax planning is to reduce your tax liabilities over the lifetime of the business and also allow you to plan from a cash flow perspective. So you're not trying to figure out what you have to pay on April 10th when the amount due is April 15th. So that's really the kind of the point of doing this now is tax planning and being proactive from a tax standpoint to ultimately keep more of your money in your pocket. So we've kind of broken this out into two different sections. So this first section, we're going to talk really heavily about the business provisions, so the things that impact the business, and then we'll get into the individual provisions. But like I said, they're really hand in hand, and a lot of these things work together. So kind of looking at it from a holistic approach when you're actually doing your planning is really important, even though maybe we're breaking it down in different sections here. So the first kind of big change, and I wouldn't really call it a big change, but it's really an extension of some previous law, is depreciation related. So bonus depreciation, 100% first year bonus depreciation's back. That's slowly been phasing out. I think it was 60% last year. Well, that's back to 100% for assets placed in service after January 19th of 25. Then also Section 179 got expanded to allow you to write more of those costs off, up to $2.5 million a year. And then that phases out of $4 million of new assets placed in service. So why does this matter? Well, if you buy assets that qualify for bonus depreciation or Section 179, you can expense those right when they're placed in service. So when we're looking at planning opportunities around fixed assets, is really looking at our fixed asset needs at the end of the year. And maybe it makes sense to buy it before the end of the year. Maybe it makes sense to push it into 2026. But having that kind of up our sleeve from a tax standpoint and a tax deduction standpoint is really, really important. So this is back, and a huge lever that we can kind of pull within tax planning as we plan around our fixed asset needs. This next one, qualified production property, this is a massive change, completely new concept. And really kind of the logic behind this and why this was put into place by this administration is because this administration has a really, they have a goal of bringing manufacturing back to the United States. And this is one of those incentives that they've put in place to do that. So what is qualified production property? So this applies to non-residential property used in manufacturing, agriculture, and chemical production. So let's just kind of take what the general rules are. You buy a building that you use in the manufacturing space. Generally, that's always been depreciated over 39 years. So you get a 1/39th deduction in each year over 39 years. Under this new law is if you buy or you build a new facility that's used in production, the portion that's used in production you could write off in the first year. So that changes from 39-year depreciation to now you can expense the entire thing or write off, depreciate the entire thing in the year that it's placed in service. So that's a massive benefit for those in the manufacturing, agriculture, chemical production space. And like I said, it only applies to the portion that's used in production. So if you build a facility that's got offices, that has, lunchroom, bathrooms, whatever, only the portion of that building that's used in production can be written off. The rest would still be depreciated over 39 years. And this just applies up until 2030. So there's a limited time frame here to take some action. Just to kind of show what this means from a dollar standpoint, kind of under the old rules and also the one big beautiful bill, using the same scenario. So let's say you buy a $2 million piece of property. Under the old rules, you would depreciate that $2 million over 39 years. So in the first year, you would get a deduction of around $51,000. And assuming that the taxpayers in the top tax rate of 37%, they would get a tax benefit of around $19,000. So that's kind of this old rule section here. Under this new rule, let's say we have the same situation where you buy or you build a $2 million piece of property, and 50% of that property is used in production. So you're actually using that in the act of producing in the manufacturing, agriculture, chemical production space. So that's $1 million that's used in that. Well, you can write that $1 million off in the first year, and then the other $1 million would be depreciated over 39 years. So $1 million you would write off in the first year. The other $1 million that's not being used in production, you would write off over 39 years. So if you just look at some of these numbers, the first year depreciation is over $1 million. If they're in the 37% tax bracket, that's $380,000 of money back in the taxpayer's pocket. So you're looking at, in this circumstance, a difference of a $360,000 tax savings in year one. So this is a huge benefit for those in those spaces that need additional capacity from a building and space standpoint to take advantage of over the next 5 years as they grow and plan ahead. So massive benefit for those in that space. This next one is one we've been waiting on for probably 5 years now. Part of the 2017 tax law changes, in order to balance the budget, they changed the rules around the research and experimentation expense deduction. So it used to be, if you had, for really the longest time, if you spent money on R&D, you got that deduction in the year that the expense was incurred. In order to balance the 2017 budget, starting in 2022, any R&D expenses you had to capitalize and amortize over 5 years. So just taking, using basic numbers, you had $1 million in R&D expenses in 2022. You didn't get $1 million deduction in 2022. You had to add that back, and you only got a portion of that deduction, and then you would deduct it over the years, the years after. So those are pretty big add backs for people in that manufacturing space and the technology space. I mean, we had numerous technology startup companies that were running at a loss that now had taxable income because most of their expenses were R&D related. So it was a pretty big add back for those people that were doing a lot of R&D. Well, this tax bill, the One Big Beautiful Bill, changed that. So now we're getting back to immediate expensing of domestic R&D expenses. So foreign R&D expenses, you still have to capitalize and amortize, but domestic R&D expenses, you can expense in the year that they're incurred starting in 2025. So huge benefit there for our business owners that are doing research and development. So now, where does the planning opportunity come into play? And it really comes into play, what do we do with these prior capitalized costs from 22 to 24? So we have all these, we had to add those all back, and we haven't taken the full deduction because you amortize them over 5 years, and obviously it hasn't been 5 years since 22. So we have all these unamortized costs sitting there that we don't really know what to do with. Well, this is where you have options, and planning really comes into play. So for businesses less than 31 million in gross receipts, you have a few options. So you can go back and you can amend your 22 to 24 tax returns and file them as if you can deduct them in those years. So you'd amend for refunds, essentially. You could take catch-up deductions in 25. So you could write off all the unamortized pieces in 25. So you just take one huge expense for the amounts that haven't been expensed yet. Or you can take 50% of those prior unamortized expenses in 25 and 50% in 2026. The fourth option is you can just let them ride out as they are. So just continue to amortize them on the current schedule. So really you have 4 options there. And it's really looking at holistically what's ultimately going to put more money back into the taxpayer's pocket. So some of the things to consider: if you amend 22 to 24, there's probably interest. So the IRS is going to owe you not only a refund, but they're also going to pay you interest on that refund. The timing of the IRS refund, the IRS isn't moving very fast right now. They're understaffed. So when are you actually going to get that cash in your pocket? Cash flow needs of the business. Like I said, when are you actually going to get the money back in your pocket? So those are just a few things to look at. Another thing to look at is what tax bracket is the business owner in? If 22 through 24 maybe we're down years, well, and they're having really good 25 and 26. Well, you want to take that deduction when they're in the highest tax bracket so that they can get the most money back, versus trying to take a refund when they're in a lower tax bracket. So a lot of things to consider there. Businesses greater than 31 million in gross receipts, similar options, except you just don't have the option to amend. So you can accelerate and take all the unamortized expenses in 25. You can take 50% in 25 and 26, or you can let them ride out. So huge planning opportunity around here around R&D expenses for those that have incurred R&D expenses in the past and going forward. This is a this is not a new concept. This is an old concept. It's just been expanded quite a bit. And this only applies for C corporations. So this is section 1202 and it's qualified small business stock. And really the goal around this is for people to invest into small businesses. And then when they sell their stock, they don't have to pay tax on the gain, or they only have to pay tax on part of the gain. And that's really the point of section 1202. And it only applies to C corporation. So if you're an S corporation or a partnership, this does not apply. And like I said, this is not a new concept, but it's just an expanded benefit of an old concept. So this applies to stock issued after the signing of this bill. So that was July 4th of 25. And it applies to companies that have assets under $75 million. So that's what a qualified small business is in their definition of section 1202 is a business with less than $75 million in assets. And it used to be that you had to hold that stock for 5 years in order to get any sort of benefit or gain exclusion upon sale of that stock. Now they've added kind of a tiered structure. So if you hold it for 3 years, you can get a 50% gain exclusion. If you hold it for 4 years, you can get a 75% gain exclusion. If you hold it for 5 or more years, you can get 100% gain exclusion. And the gain exclusion is up to $15 million. It's the greater of 15 million or 10 times your basis. Generally, it'll be $15 million. So if you sell your qualified small business stock with a gain of $15 million, you're not going to pay tax on that $15 million. That's the benefit there. It used to be 10 million, so it got increased by an additional $5 million. There's a lot of planning that goes into this, because if you just think about the tax rates of a C corp, because it only applies to C corporations. So C corporations pay tax at 21%, and then you also pay tax on any of your distributions, generally at 15 or 20%. So generally that effective tax rate of a C corporation is 36 to 41%. So it's kind of it's a pretty high number, where if you're an S corporation or a partnership, not including everything here, but the top tax rate at the individual level is 37%. And then you have what's called a qualified business income deduction, which is 20% of your qualified business income. So really your top tax rate as an S corporation or partnership is only 29.6%. So 29.6% versus 36 or 41%. Maybe this gain exclusion doesn't make sense, right? So, but if you're in a business where, you're going to start this thing up from scratch, you're going to build it and you want to flip it and sell it in 5 years and you qualify for section 1202, it might make sense. Or maybe you're investing in a new product line or something. It might make sense to spend that off into a new entity and get 1202 treatment. So there's a lot of planning that goes around this when we're talking about entity structure. It's not just one size fits all, everybody be a qualified small business because you don't have to pay tax on sale. It's okay, let's think about all the factors of when you're actually running this business and you're paying tax from a year-to-year standpoint. But again, another really good option here from an entity structure standpoint. I'm not going to spend a ton of time on this because there's really not a huge change here. But just kind of high level business interest expense deduction. The goal, this was put in place in 2017. This just kind of pretty much got expanded with a little bit different rules. But they didn't want companies with a ton of business interest expense to drive their company into a loss with their interest expense deduction. So that just got expanded, but they did increase the base for that. So now you can add back depreciation, amortization in that calc. So it gives you a better chance to deduct that interest expense. So not a huge change there, and probably doesn't apply to a ton of people on here, but just a minor change that got extended. And then also the excess business loss limitation got extended as well. Essentially, the IRS's goal here is they don't want your business losses to offset all of your other income. So there's limitations on how much business loss you can use to offset things like investment income, so interest, dividends, capital gains, and then also your W-2. So that just got extended as well. No big change there, but a few things that could impact you going forward as a business owner. And then this was a huge win. This was something that we were monitoring really closely. is the qualified business income deduction. So those that are S Corp or partnership owners, I mentioned this briefly in a previous slide, but you generally can get a deduction for 20% of your business income at the individual level. So if you have $100,000 of business income, you only really have to pay tax, assuming that you're maximizing this, on $80,000. So huge benefit. It reduces that top rate from 37% to 29.6%. And this got extended. So this was previously set to expire at the end of 25, and now it's been permanently extended going forward. So this is a huge benefit for our business owners that are S Corps and partnerships. There were some minor expansions of this. So if you're a service business, there's some expansions, and then there's also a minimum amount that you can deduct. But not really any huge changes, just a really big expansion of previous law that we were waiting on that impacts really all of our clients, especially that are S Corps and partnerships. And then this kind of last slide, these are some other provisions, and I'm not going to talk a ton about these. Just want to make everybody aware that they're out there, and we can certainly connect offline if you have questions on these. But the Qualified Opportunity Zone program, there were some extensions there and some changes, new market tax credits. And then the biggest one here is probably green energy credit changes. So those are slowly starting to phase out depending on what you're buying. Actually, I think the first phase out is at the end of this month. So if you're planning on investing in green energy, I would act sooner rather than later and talk to, we can connect offline or talk to your tax advisor about when to do that, because there's kind of these aren't going to be around forever, and they phase out really anywhere from the end of this month through 2027, depending on what you're kind of buying. So just some changes here that I don't think they're going to impact a ton of people on this call, but just to be aware of. And if they do impact you, if you're interested in it, I'm happy to have a conversation offline. So that's kind of the business section. I guess I will open it up for any questions before we get into the individual section. If there's any questions in the chat or anybody on the call has any questions.
I'm not seeing any on the Zoom right now. Laura, can you see anything on the Facebook?
No, nothing there yet.
I have a question.
Yep.
Is there going to be anything coming down the pipe about that's going to be better for employer withholding taxes on this? Or like just the cost of that?
Yeah, we've not seen anything.
Okay.
So nope, not seen anything. But there are some proposals out there with some changes to what we're talking about now, but I've not seen anything with employer withholding.
Okay. All right. Thank you.
Yeah, no problem. Thanks for the question. Any other questions? If not, I'll keep on keeping on.
I'm not seeing anything else.
Perfect. Sounds like a plan. Well, we will get into some of the individual provisions now. So these impact the individual taxpayer. But like I said, most of our business owners are S Corps and partnerships, so they don't really pay tax at the business level. They pay tax on the individual level. So this is these are very connected, even though they're individual focused. So this first one is the state and local tax deduction. This was a change we've been, again, waiting on for a long time. So back in 2017, there was a big change at the individual level where they only allowed you to deduct federally $10,000, up to $10,000 of your state and local taxes. So that includes property taxes, personal taxes like car tabs, and then also your state taxes. So that it capped it at 10,000. So if you paid more than that, you got zero federal benefit for it. You just got up to a $10,000 deduction. So this really impacted a lot of those that are in high income tax states because they were paying all these state taxes, but they weren't getting a federal deduction for it. So that changed with this tax law. So If you're making less than $500,000 a year, you can deduct up to $40,000 of your state and local income taxes on your federal tax return. And that's increased annually for inflation from 26 to 29. It goes back to $10,000 in 2030. Now that $40,000, it phases out between $500,000 and $600,000 of income. So if you make $600,000, you're only going to get a deduction of $10,000 for your state and local taxes at the individual level. So there's a lot of planning that goes around here that if you have a significant amount of state and local income taxes, that, whether it's retirement planning, changes of accounting methods, whatever it is, fixed asset planning, to keep your income at that $500,000 or below, so you can deduct more of those state and local income taxes. And I'll show an example here in a minute of kind of what that looks like from a dollar standpoint of why this is so important. The one thing that did stay in play is the pass-through entity tax election. So with the change in the deduction for state and local income taxes back in 2017, a lot of the states allowed S corporation and partnership owners to actually pay their state taxes on their business income at the entity level. So they would pay it at the S corporation or the partnership level and take the deduction at the S corporation or partnership level, and that would then pass through to their individual. So they would, in essence, they would get the full deduction anyways on their business income, but then it would still be limited on any other income at the personal level. So your W-2 investment income, so Schedule C. So if you're a single member LLC, if you're you own any personal rental properties, that would all be limited to $10,000. So potentially massive benefit that there's a lot of planning around. Then I'll show you kind of a quick example of why this matters. So the difference between $500,000 and $600,000 of income. So the first scenario, there's $500,000 of income. This is just kind of a hypothetical scenario. They have $75,000 of itemized deductions. Of those $75,000, they have $40,000 of state and local tax deductions. So that's built into the $75,000. So because they're $500,000 or under, they can take the full $40,000 deduction here. So they're looking at taxable income of $425,000 and tax of about $118,000. Again, that's maximizing the state and local tax deduction because they're $500,000 or under. Now, let's say they, their taxable income or their adjusted gross income goes to $600,000. Well, now their itemized deductions are only $45,000 because the extra $30,000 of the state and local tax deduction is no longer there because it goes back to 10 because they're over $600,000 of income. Now their taxable income is $555,000 and they're paying tax of $164,000. So what's kind of the point of this? Well, just that $100,000 increase in income, you're paying 45.5% tax on that. So you're paying an additional $45,500 of tax on that additional $100,000. So what can you do to change that? Well, retirement planning, maybe maximize your 401k. If you're a business owner, you can look at methods of accounting, right? Obviously, you still have the pass-through entity tax that you can take advantage of, fixed asset planning, HSA contributions. The list kind of goes on and on and on to make sure that even though you have $600,000 of income, but how can we defer some of that so we can maximize the state and local tax deduction so you're not paying tax at 45.5% on that additional $100,000. So a lot of planning opportunity here. And obviously, once we get to the end of the year and once we get to 2026, there's not really much we can do from a planning standpoint after the year's already closed. And now's the time to start making those moves to make sure we're maximizing this deduction. Okay, this was a big thing that this administration ran on. No tax on tips, no tax on overtime. And it's been put in play, and there's some nuances here that I just want to make sure everybody kind of understands. So no tax on tips. This is a deduction. So you'd still pick up all the income from your tips, and then you would just get a deduction on your personal tax return. and it's up to a $25,000 deduction per taxpayer per year. So if you're joint, you can get up to a $50,000 deduction. It only applies for 25 to 28, so it's gone after 2028. And it phases out. So if you're married filing joint and you have income over 300,000, that deduction phases out. So if you're a high income taxpayer, and maybe one of you are in a tip industry, and your spouse makes a lot of money, there's potential that you could not receive this benefit. This only applies to those that are in tipped industries. So waitresses, waiters, hairstylists, barbers, those types of industries that are regularly tipped. That's who this applies to. If you're not in a regularly tipped industry, this does not apply to you. And it only applies to the voluntary tip portion. So on the receipt, you go to a restaurant, some restaurants have a built-in tip of 20%. It doesn't apply to that. It only applies to the voluntary portion. It also doesn't apply to service charges and stuff like that. It's only the voluntary portion of the tip. So it's a deduction. So no tax on overtime. Again, similar concept. The deduction is limited to $25,000 for marriage filing joint. So no tax on tips is per taxpayer, $25,000 per taxpayer, where no tax on overtime is only $12,500 per taxpayer. So if you're married filing joint, you get $25,000. You can get up to a $25,000 deduction. It only applies to 25 through 28, and again, the same phase outs. Apply. So if you make more than 300,000, you're not going to get this benefit. The other thing I want to add on the no tax on overtime, and I think there's some confusion about this deduction only applies to the overtime portion. So if you're paying somebody $20 an hour and they're working over 40 hours a week, so you have to pay them time and a half, so that's $30 an hour. The whole 30 does not apply. It's only the additional portion. So just the $10 addition qualifies for the no tax on overtime, not the $20 base pay. So I know that's kind of a bit of a piece of confusion and maybe wasn't clear, when they were writing this bill, but it's not as big of a benefit as some thought, where if, I work more than 40 hours, well, I'm not paying tax on any of that income. No, it's just the addition of the additional income from time and a half. It only also applies to those that are in kind of an overtime industry. So if you're generally in a salary type industry, this would not apply. So you can't just change your whole payroll structure and say, well, now everybody's working overtime to take advantage of this. There's some guardrails around that. The other piece of this is the IRS is not going to change the W-2 forms for 25. I think they're considering and looking at changing them for 26. So from a compliance standpoint, on the business owner's side, we're still waiting on some guidance on this, but you'll have to give your employee that information of what portion was overtime, so that they can then take the proper deduction on their 1040 or their personal tax return. So a couple nuances there. Potentially pretty big benefits, but there are some phase outs. You see a lot of phase outs in these. So like I said before, planning is really important no matter who you are, to make sure that you're getting the benefit of these deductions. This one can be kind of confusing, and I'm not going to go completely in detail, and it doesn't apply until 26. So this doesn't apply for 25. And really what they want is they don't want those in the top tax bracket, so the 37% tax bracket, to receive a 37% benefit on their itemized deductions. What they want to happen is they want those itemized deductions to be limited for those people in the 37% bracket to only 35%. So that's really what all this jargon on this page is talking about, is if you're in that top tax bracket, so if you're single and you're making more than $626,000, or if you're married and you're making more than $751,000, they don't want you to receive a benefit of your itemized deductions at 37%. They want you to they want it, and they're going to make it capped at really 35%. So that's really what the itemized deduction limit is doing. Only applies to those in the top tax bracket. This next one, So the senior deduction, seniors can get up to a $6,000 deduction for 25 through 28, and that's per senior. So if you're married filing joint, that's up to $12,000 deduction. And then again, there's phase outs here as well. So if the married filing joint's making more than 150,000, that $6,000 or $12,000 deduction is going to be phased out. You're not going to receive the benefit. So there's some planning done around here for seniors as well. The charitable contribution. So this is potentially a big one, especially for the higher income taxpayers that are very charitable. This does not go into effect until 2026, so it's not for 25. But what they're doing is they're putting a floor on the amount of deductions that you can take. And so you only receive the benefit of your charitable contributions to the extent that they exceed 0.5% of your adjusted gross income. So let's just use an example. Say you make $100,000 and you give $5,000 to charity. Well, 0.5% of that $100,000 is $500. So you don't receive the benefit for that first $500 because that's 0.5% of your income. You only receive the benefit for the charity that's in excess of that 0.5%. So if you donate $5,000 and you're in that kind of situation, you'd only get a deduction of $4,500 versus the full $5,000. So obviously you can see that that number gets pretty high for those that are high income taxpayers. So if you're making $1 million a year, 0.5% is a pretty high floor that you have to donate in excess to get a tax benefit of that for that donation. They've also added a non-itemizer deduction. So if you don't itemize, those married filing joint can get up to a $2,000 deduction for their charity and $1,000 for the other filers. So you don't necessarily have to itemize to get a benefit for your charitable contributions. But I know this new floor that they've put in service for 26 and going forward certainly needs to be planned around, because if you have more income and you're really charitable, well, you might be giving that money away and not receiving a tax benefit for it. So making sure that we're planning around that. And then this also interplays with the itemized deduction limitation that we talked about on the last screen, where they only want you to receive a benefit at 35% versus 37%. So a few things to think about, but this one's not until 2026. So these couple things, I'm not going to spend a ton of time on these, but this first one is just to be aware of. This doesn't go into effect until 27. So we have a couple years here, but it's for donations to scholarship granting organizations. And the state of Ohio already has a credit for this. I know we have a lot of clients that give to a lot of private schools, and they get a credit at the state level for some of the I think it's like $750 for those donations. Well, now there's a new federal credit, so you can get up to $1,700 per year. If you donate to, and this is a credit, so it's not a deduction. So it's a dollar for dollar reduction in your tax. It's not a deduction, it's a credit. So if you give $1,700, you get a reduction in your tax of $1,700 for donations to these scholarship granting organizations. The federal credit is reduced by any state credit received. So like I said, the state of Ohio has a credit for a credit as well, mainly for a lot of the private schools. So if you take a $750 Ohio credit, your federal credit gets reduced to $950. So they don't stack on top of each other. And then also, if the credit amount is not eligible for a charitable deduction, so you can't get a credit and get a deduction for charity. It's just a credit or one or the other type situation. So it's but potentially a really, really good benefit if you're charitable and you give to a lot of these scholarship granting organizations. And again, that starts in 27, so there's nothing to do for 25 or 26. And then 529 accounts. So there's been some changes here that start in 2026. So you can take out It used to be $10,000. Now it's been increased to $20,000 for K through 12 expenses without incurring any penalties. So if you have K through 12 expenses, instead of just being able to withdraw 10,000 for those from your 529, now you can do up to 20,000. And also there's some expanded eligible expenses. If you have any questions on that, we can certainly take this offline. And then it also starts to cover post-secondary credentialing. So in our industry, we all get our CPA, or we strive to get our CPA license. So you can use some of these distributions from 529 accounts to help pay for that, exam materials, then also the cost of the exam without incurring a penalty. Again, effective for 2026, not 2025, just an increased threshold here. Nothing really huge change outside of just some expanded eligible expenses. Qualified passenger vehicle interest expense. So this is for interest expense on eligible vehicles, and they have to be new vehicles, and they have to be purchased between 25 and 28. So this is done after 2028. And the kind of the caveat here is, again, this goes back to this whole administration's kind of push to bring manufacturing back to the United States. So this only applies to final assembly being done in the United States. So it doesn't apply if the vehicle's being assembled overseas. And it only applies to vehicles less than 14,000 pounds, which are most vehicles. So that's not a huge number there, or a huge change there. It's not available for business use vehicles. So obviously, you would, if you use it in your business, you would have that in your business. You would depreciate it and deduct the interest piece in the business. And there is a phase out here as well. So if you make more than $200,000, your benefit of that interest expense is going to be reduced. So the deductions limit is 10,000. If you make more than 200,000, you're not gonna receive that benefit. Again, I think the main caveats here are it's limited from 25 through 28, and it's only on final assembly being done in the United States. So those vehicles, not the ones being done overseas and then being imported. And then there's the phase out again. Like, I think that's a common theme across all these, is there's some sort of phase out. So there's some planning that needs to be done to make sure we're maximizing all these deductions at the individual level. Gambling losses. So I don't know how much this applies to everybody here, but the old rule was you could only deduct gambling losses up to your gambling winnings. So you couldn't take a net loss for gambling, but you could offset your gambling winnings by up to zero by your losses. This changed to be only 90% of your gambling losses are now deductible. So this may or may not be a big change depending on how many losses you have. But let's say you have $100,000 of gambling winnings and you have $100,000 of gambling losses. Well, you used to just be able to offset those, so you pay no tax. So you have zero because you had 100,000 winnings, 100,000 losses. That's net zero. Where now you can only deduct 90% of your gambling losses. So if you have $100,000 of winnings and $100,000 of losses, we have to pick up the 100,000. Then you only get a deduction of 90,000 because it's limited to 90%. And then there's still the limit of losses being subject to gambling winnings. So it may or may not come into play. Let's say you have $100,000 of gambling winnings, but $150,000 of gambling losses. Well, 90% of the 150 is still greater than the 100,000. So you still can offset all of your winnings, but it's kind of in those circumstances where either your winnings are more than your losses or your winnings are about the same as your losses, where you're going to have a tax liability for those winnings. And this is effective after starting in 2026. So not a 25 thing. And then this was a pretty big win as well. These are just extended items, so no changes here. There was the individual income tax rates were extended. So the top rate used to be 39.6%, and then in 2017 it got back down to 37%. So that's been extended. And then also the increased standard deduction also got extended. So in 2017 that got, I think, almost doubled from what it used to be. So that's been extended as well. So these all say permanent. Where it says permanent in these slides, it's permanent until the next administration changes it. So even though it says permanent, it's not something that's going to be around forever, because most likely if there's a new administration from a different party, they're going to push to change some of these things. So they're permanent for the time being, but these things have been extended from the 2017 Tax Cuts and Jobs Act. Okay, we have a few more. I guess now is probably a good time to see if there's any questions on the individual or the business piece.
I have a question on the tax on overtime.
Yep.
I use a payroll company that does our payroll, but
Yep.
when at the end of the year, does the employer get the credit on the overtime taxes that we pay to, or is it just the individual that gets the credit?
Just the individual. So there's no impact on the Social Security and Medicare taxes. It's just an income tax deduction. So just the individual gets the benefit for that.
Okay.
Yep. Yeah.
I'm
So
sorry,
what?
that was a dumb question, but
No, good, really good question. Really good question. And your payroll company will probably have some sort of report that tracks the overtime portion. So there's not a ton of guidance on this yet, but what you'll have to do, since they're not changing the W-2, is you'll have to furnish those employees with that report that shows them how much overtime they received so that they can then take the deduction at the personal level. So.
okay.
So I have a
Thank you.
question.
Yep.
With all these changes
Yep.
and with the reduction of staff and they're behind to begin with, is the IRS ready for this?
Well, that's a good question, and I don't really know the answer. So I can tell you what I've heard. So the good news is they passed this in the middle of July. So we still have 6 months. Well, not anymore, but they really had 6 months to put this into play. And they've actually already released some draft forms related to the no tax on tips and no tax on overtime. So they've already released draft forms. However, I will say that I listened to a call. Well, I listened to it was after the fact, but I listened to a call of from the IRS commissioner, and he did say that probably the tax forms and the e-file system will probably not be open until late February this year. So and then after that, all the tax softwares are going to have to update their tax softwares to the third-party tax softwares are going to update their softwares for the changes. So we're probably looking at a later start to the tax filing season, where usually it starts at the beginning of February. Now it might not start until the end of February, early March. So there's going to be a pretty big crunch there, because we have the S corporation and partnership deadline of March 15th. So I don't know exactly how it's all going to play out, but I do foresee, and we're already starting to talk about it internally about how we're going to handle this, because that's what the IRS commissioner did say. I don't know. Was that helpful?
Well, I didn't actually expect you to have an answer. I just kind of,
Yeah.
but I appreciate your opinion and perspective on it, because this is a lot of changes, and
Yeah.
we know they don't move fast to begin with. And
Right.
I'm like, kind of good luck.
Yeah, exactly. Yep. Yeah, we're still waiting on guidance on a lot of things. So, usually I think back to, when 2017 happened, there were a lot more extensions filed that year, to catch up for the changes and make sure that we weren't filing returns that we had to later amend. But yeah, you're right. You're right. So we'll see the timing of things as things unfold.
So I guess this year more than ever, if you are looking for a CPA firm or changing CPA firms or something, you better do that sooner than later, it sounds like.
Yeah, we'll do that. Yeah, do it sooner than later. And really we're in that tax planning time. I think that's really the focus, not necessarily filing of the tax return. If you do your tax planning right, filing of the tax return is just a formality. And you already know the answers well before you actually have to file your return. So really now we're in late September. I mean, we're already heavy into tax planning season. So yeah, if you want to take advantage of some of these things, it's probably a good idea to start start having those conversations now, so that you can before the end of the year. Any other questions on these? There's a couple more here that won't take very long, but
Yeah, I don't have any questions on Facebook.
perfect. So just a couple other changes. So the estate and gift tax exemption, this was a big win. So the estate and gift tax exemption got increased to 15 million. This was going to expire at the end of 25 and go back to 7 million. So if you're thinking about business owners and the value of their business, most of our clients had and a lot of business owners on this call, if you add up all your stuff, it was probably over $7 million. And that would be taxed at a 40% rate in your estate, where now that's been lifted to 15 million. So it allows that the estate, it's less likely for the estate to be taxed upon the owner's death. There's still a lot of planning that needs to go into play with wills and trusts and stuff like that to keep things out of probate. But this was a pretty big win on the estate and gift tax side of things. This next one, again, not going to talk a ton about. We're still waiting on a lot of guidance, but there's these Trump accounts that are coming into play. And really, I guess the point here is, these are tax deferred saving accounts for children, and they're not going to be available until at least next year, 27 most likely. So something to be aware of. Don't have a ton of information on this yet, but just wanted to kind of bring it up. And we can certainly connect offline if you have any questions on that. 1099 reporting. So this is more of a cost of compliance. So this is a big win for business owners. So generally, if you paid somebody more than $600, a contractor or rent or whatever, if you paid somebody more than $600, you had to issue them a 1099 MISC or a 1099 NEC. Starting in 2026, that threshold gets increased to $2,000. So it's no longer 600, it's 2,000. These will be continued to be indexed for inflation. And then the 1099K reporting thresholds are at 20,000 or 200 transactions. So potentially a helpful compliance lift there for our small business owners, where now you have a $2,000 threshold to issue 1099s versus a $600 threshold, like it used to be starting in 2026. And this last one, the employee retention credit. So if you're still waiting on some ERC money, this might impact you depending on what quarters you applied for a refund. But this only applies to Q3 and Q4 claims. Q4 only recovery startup businesses could claim. So most businesses, this only applies to Q3 of 2021. But if you made a claim after January 31st of 24 or Q3 or Q4 of 2021, and you essentially aren't going to receive that money. Now, if you made a claim before that date, then yes, you're still entitled to that money. But if you made that claim afterwards, you will not receive that money if you have not yet. And then it also extends the statute of limitations to 6 years for Q3 and Q4 of 21. So instead of the IRS only having 3 years to look at your claim, they now have 6 years for those quarters. So small, probably not a huge change for a lot of people, but there are a lot of business owners still waiting for their refunds to come back from ERC. And there's certain quarters, if you did not apply, before or file your amended 941 before January 31st of 24, you probably aren't going to receive that money. Well, not probably, you aren't going to. So. And that's all I have. I think probably just to wrap this up, kind of my last closing, and then we'll open up for questions is, one thing that's come up is you'll see a lot of thresholds within a lot of these changes, a lot of interconnectivity between a lot of these changes. So like we've said, planning, I think has always been important, but I think it's even more important no matter who you are, whether you're just an individual taxpayer or whether you're a business owner who ultimately pays tax at the individual level. planning is really important to make sure we're maximizing all these deductions and we're not being limited by a lot of these thresholds, both at the business and the personal level. So just something to think about as we sit here in September, and we get closer to the end of the year, to make sure we're addressing these things and ultimately doing our best to create a strategy that keeps more money in our pockets, and aligns with our overall strategy from a business or individual perspective. So that's all I have. So I will open it up for questions.
I don't have a question, but this has been extremely informative. And just to let everybody know who is on here, this will be on our YouTube channel because there's a lot of information. So unless you were taking copious notes, you can always refer back to our YouTube channel to review some of the changes. So I think this has been a terrific presentation.
Awesome. Yeah. Thank you for having us. And like I said, my contact information's up here, so feel free to shoot me an email, reach out, connect through LinkedIn, Facebook, whatever it is. You can find us, and we're happy to help out and help you with some tax strategy.
Thank you. I agree. It was a great presentation, and I learned a lot. I'll be reaching out to see
Sounds
about
good.
you taking care of our small business. So.
Awesome. Thank you. Yeah, thank you very much. I appreciate it. And we're looking forward to connecting.
And Brenda Savage from Caldwell Banker wrote in the chat, "Thank you," with an exclamation.
Awesome. Thank you. I appreciate it. So cool.
Right. Well, Jared, so did you say that you'd be able to send me this presentation so I can send it to everyone on the call today?
Yep. Diane and I will send it on over so you can post it.
Awesome. Thank you so much. Guys, thank you for being here and giving this robust presentation to inform us. If you guys want to keep in touch with the Greater Hamilton Chamber of Commerce, head to our website, hamilton-ohio.com. Coming up next, we have Southern Ohio Young Professionals, which is happening the 26th. So that's going to be this Friday. From 4 to 6 at Hydraulic Bar. So if you know someone from 21 to 40 and they want to network, have them come out to Hydraulic Bar. We also have State of the City that's going to be happening at the new Cohatch in Hamilton on Main Street. We are sold out. So if you did not get your ticket, I apologize. Hopefully you'll come to the next one. We also have Networking Leads happening October 21st at Dill Dinkers Pickleball courts. So everyone have a wonderful week. Thanks for joining us today. Have a good one.
Hold on, Tiffany.
I was just going to say you can watch State of the City live since we're sold out on the TV Hamilton Facebook channel and also the Chamber of Commerce Facebook channel.
Awesome. Thank you, Tiffany.
And the candidates forum is tonight. So if you want to be informed about who's running for city council, either attend at Miami on High Street or it'll also be Facebook Live. Thanks, everyone.
Thank you.
Good day.